Hi there, this is Simon, personal finance coach. With Treasuries and CDs paying under 4% interest, a lot of people are having a hard time to figure out how to generate higher monthly income without taking on too much risk or dealing with ups and downs of the stock market. In this video, I will walk you through an approach that I use to build a portfolio that earns over 6% in reliable income with a moderate risk. The 2% difference between 6% and 4% can be huge. For example, at 4%, a $2,000 a month income becomes $3,000 at 6%. That is an extra $12,000 a year. And if you're earning $4,000 a month at 4%, that becomes $6,000 at 6%, a $24,000 additional income annually. Before we dive in, make sure to subscribe to get notified on future videos. There are many asset types that can be considered for income generation investments. Some are straightforward, traditional, others are sophisticated alternatives. They differ in returns, risks, and liquidity. Before we create a 6% return portfolio, we need to understand what investment choices you should consider and the trade-offs they offer in terms of returns, risks, and liquidity. Watch this video to the end, and once we go through the investment choices, I will suggest an approach and specifics for the 6% plus return portfolio. So there are three most common and traditional asset types that I consider for income generation. One is cash and equivalents, two is fixed income, three, dividend equities. The first type, cash and equivalents, includes investments in high-yield savings, certificates of deposits known as CDs, treasuries, corporate bonds, and municipal bonds. The beauty of these investments is that the principal stays steady if held to maturity. Basically, until maturity, you are paid regular payments, and at maturity, you get all the principal back. Let's do a quick dive into each of these investment types. High-yield savings offered by banks, online platforms, and brokerage firms offer higher interest than traditional saving accounts. Interest usually paid monthly. They are very low risk, insured up to $250,000 per depositor per bank, and are highly liquid with no maturity dates. CDs are fixed-term deposits ranging from 3 months to 10 years with a guaranteed interest rate. Your money is locked in until maturity, and interest is paid periodically, monthly, quarterly, annually, or at maturity. They are very low risk, insured up to $250,000 per depositor per bank, and are safe and predictable. Treasury bills are short-term from a few days to 1 year. Treasury notes are medium-term from 2 to 10 years, and Treasury bonds are long-term from 20 to 30 years. Treasury bills pay interest at maturity. Treasury notes and Treasury bonds pay interest every 6 months. They are very low risk, backed by U.S. government, provide stable payments. A very efficient way to invest in treasuries is to build a ladder that staggers maturities across several time periods. This creates consistent income while reducing interest rate risk. For example, you might allocate $250,000 of your portfolio into a 5-year treasury ladder, purchasing $50,000 in treasuries that mature in each of the next 5 years. This approach generates regular income and returns principal every year. Number 4 is corporate bonds. They are loans to companies for a set period of time. Interest payments typically are semi-annually, usually higher than treasuries. Risk varies dependent on the issuer credit rating. Higher rating, lower the yield. Same as with treasury ladder, creating a corporate bond ladder is an efficient way to invest in corporate bonds. Number 5 is municipal bonds. They are loans to municipalities for a set period of time. Interest payments typically are semi-annually and are federal income tax exempt. Risk varies depending on the issuer's credit quality. The next investment type is fixed income asset type, includes investments in treasury bond funds, corporate bond funds, and municipal bond funds. For these investments, the principal does fluctuate with the market, and the funds do not have a monthly maturity date. Treasury bond funds are pooled investment funds that hold a variety of treasury bonds. Payments typically are monthly or quarterly. Risk varies depending on types of bonds. Corporate bond funds are a type of funds that invest in corporate bonds issued by companies. Payments typically are monthly or quarterly. Yields usually are higher than treasury bond funds because of the higher credit risk. It can include safer investment grade bonds or riskier high yield junk bonds. Municipal bond funds invest in municipal bonds which are issued by states, cities, or local governments. Payments are usually monthly or quarterly. Dividends often are tax exempt at the federal level and sometimes state and local levels if you live in the issuing state. Risk generally is low to medium depending on the credit quality of the municipalities. The third investment type is dividend equities asset type, and it includes investments in dividend stocks, preferred stocks, utility MLPs, and REITs. These investments differ in structure and risk. The principal does fluctuate with the market, and the funds do not have a monthly maturity date. Dividend stocks are common stocks of companies that pay regular dividends. Payments typically are quarterly, risk is moderate, stock price can fluctuate, dividends can be cut. Dividends provide a stream of income, but are not guaranteed like in bonds. Preferred stocks are hybrids between stock and bond, typically issued by financial and insurance companies. They pay fixed dividends, often higher than common stock dividends. Payments are typically quarterly, and risk is higher than bonds, but lower than common stocks. Income is relatively predictable, but the stock price can fluctuate. Utility MLPs, which is master limited partnerships, equities structured as partnerships, usually are issued by energy and utility companies. They pay distributions to investors, typically quarterly, often higher yields than stocks. Risk is medium to high. They are sensitive to energy prices. Offer steady cash flow, but more volatile than bonds. REITs, which is real estate investment trusts, are companies that own income-producing or mortgage real estate. Payments are usually quarterly, risk moderate to high. They are sensitive to interest rates and real estate markets. They provide high dividend income, often higher than standard stocks, but are sensitive to market and property risks. Now, once we cover the 3 income investment types and 12 investments, and we understand the trade-offs they offer, we can create our target 6% portfolio. The goal is to build a portfolio that balances returns and liquidity based on your individual timeline, risk tolerance, and income needs. No single portfolio will be optimal for all investors. Given the investment choices, we can create portfolios that are different for different individuals depending on their choices for returns, liquidity, and risk. Let's assume that I'm working with a $1 million in savings. The approach is amount agnostic. The use is applicable to a $100,000 investment or a larger $10 million. First, I am deciding allocations for asset types. I decide to allocate 30% of the portfolio to cash and equivalents, 35% to fixed income, and another 35% to dividend equities. The 30% of cash and equivalents allocation secures me access to emergency funds needed with a short notice, and the fixed income and dividend equity allocations provide me with an upside for high returns at the expense of longer time horizon and fluctuations of the principal. For the cash and equivalents, I decide to put in 5% into high yield savings account offered by Fidelity and paying 3.8%, 10% into Treasury bond ladder paying 3.75, and 15% into corporate bond ladder paying 4.11%. For the 35% fixed income allocation, I decide to put in 10% into short-term Treasury bond fund, such as SGov, paying 4.35%, and 25% into an A-grade corporate bond fund, such as JAAA, paying 5.63. The 35% dividend equities allocation, I decide to put in 5% into dividend stock, such as Verizon, paying 6.37% dividend, 20% into preferred stocks such as CPRN offered by Citibank, paying 9.32, and 10% into utility MLP such as ET, paying 7.71%. The sum of all this up, the investment portfolio produces a 6.49% return with over $5,000 in income monthly and over $61,000 in income annually. Using this illustrated approach, you can create your own income portfolio spreadsheet and assess your preferences by choosing different allocations and different investment selections. Depending on your risk and time horizon preference, using the approach, you can achieve as high as 8 or 9% return or stay at 4% return if you prefer a safer path. Hope this video gave you an approach on how to build your own income-generating portfolio based on your personal preferences. There are, of course, many other alternative income investment choices, but they are more sophisticated and are outside the scope of this video. Thank you for watching. If you find this video helpful, make sure to subscribe so that you can get notified on future videos.